The envelope arrives in April. Inside is a bill for $900. She writes the check. She mails it. She moves on. What she doesn't know is that she shouldn't have owed a single dollar. Not because she made a mistake. Not because she cheated the system. Because 5 different legal protections built into the tax code, specifically for people in her exact situation, were never applied to her return. Her tax preparer didn't mention them. The IRS didn't send a notice. And she, like millions of retirees right now, had no idea the money was even hers to keep. This isn't a story about tax evasion or aggressive loopholes. This is about provisions written directly into federal law. Provisions designed to reduce the tax burden on retirees. Provisions that exist right now, fully legal, fully accessible, and almost completely ignored. Not because people don't want them, because most retirees don't even know they exist. Let's talk about what actually happened to someone we'll call Barbara. She's 67 years old. She worked for the Postal Service for nearly 3 decades. She retired with a pension and Social Security. She lives modestly. She doesn't have investments. She doesn't have rental properties. She doesn't have complicated income. Every year, she takes her documents to the same tax preparer she's used for over a decade. She trusts him. He's nice. He's local. He's been doing this for years. Last April, he told her she owed $900. She paid it, and she moved on. Here's what nobody told her. She qualified for at least 5 separate tax breaks that would have dramatically reduced or completely eliminated that bill. Not one of them appeared on her return. So where did the system break down? It wasn't fraud. It wasn't incompetence. It was something quieter and far more common: assumptions.
Her preparer assumed she was getting everything she was entitled to because the software auto-filled certain fields. She assumed her preparer knew what he was doing. The IRS assumed everyone filing a return already knows about the breaks available to them. And in that gap between assumptions, real money gets left behind. Every single year. So let's fix that. Let's go through these 5 tax breaks one by one, what they are, who qualifies, and why so many people miss them, even when they're sitting right there in the tax code. Tax break. Number 1. The additional standard deduction for age 65 and older. This is the most basic one, and somehow it's also one of the most commonly missed. Here's how it works. When you turn 65, the IRS increases your standard deduction automatically, not by a token amount, by a meaningful chunk. For the 2026 tax year, that extra amount is $2,050 if you're single. If you're married filing jointly, it's $1,650 per qualifying spouse. So if both you and your spouse are 65 or older, that's an extra $3,300 combined, on top of your already elevated standard deduction. Now, most people assume this gets applied automatically when they file, and in theory it should. But here's the problem. It only gets applied if your age is entered correctly in the system. If the preparer or the software doesn't check the box that says age 65 or older, the deduction doesn't apply. And you'd be surprised how often that box just doesn't get checked. Maybe the preparer was in a rush. Maybe you switched preparers and the new one didn't update your profile. Maybe the software didn't carry over your birth date from last year. It sounds like a small clerical issue, but it costs real money. Here's something else almost nobody talks about. The same additional deduction applies if you're legally blind, not having trouble seeing. Legally blind, as certified by an eye care professional. And here's the key. These deductions stack. If you're 65 or older and legally blind, you get both additional deductions. For a single filer who qualifies for both, that's an extra $4,100 on top of the base standard deduction. I've personally reviewed returns where someone had documented vision impairment, qualified for the legal blindness designation, and the box was never checked. Not because anyone was hiding it, because no one thought to look. So the first thing you need to do right now before you file your next return is pull out your most recent tax return and check line 12 on your Form 1040. Look for the box that says age 65 or older. Is it checked? If you were 65 or older when you filed and it's not checked, you left money on the table. And if you or your spouse are legally blind and that box isn't checked either, you left even more. Tax break number 2. the senior bonus deduction. This one is brand new, so new that most tax preparers aren't even applying it yet. In mid 2025, a major tax law was signed that created an entirely new deduction specifically for people aged 65 and older. It's called the senior bonus deduction. Here's how it works. If you're 65 or older, you can now deduct an additional $6,000 from your taxable income. If you're married and both spouses are 65 or older, that becomes $12,000 combined. This is on top of your standard deduction, on top of the age-related increase we just talked about, on top of everything else. And here's what makes it especially powerful. You can claim it whether you take the standard deduction or itemize. That matters because most retirees on fixed incomes don't itemize. They take the standard deduction because it's simpler and usually higher. But this deduction applies to everyone who qualifies, regardless of which path you take. Now, there are income limits. If you're single and your modified adjusted gross income is above $75,000, the deduction starts to phase out. For married couples filing jointly, that threshold is $150,000. Below those numbers, you get the full deduction. Above them, it shrinks gradually until it disappears completely. But here's the thing. Most retirees are well below those thresholds, especially retirees living on Social Security and a pension. So for the majority of people reading this, the full deduction is available. And it's claimed on a new schedule, Schedule 1A, that gets attached to your Form 1040. Here's the critical detail. This deduction is only available for tax years 2025 through 2028. After that, it's gone. Unless future legislation extends it, this is a temporary window, which means if you don't claim it now, you lose it. And here's the problem. The deduction is so new that the IRS itself issued a warning stating that not all tax software is programmed to apply it automatically. That means even if you're using popular software to file, you might not be getting it unless you manually add it. And if you already filed your 2025 return without it, you can amend. You have 3 years from the original filing date to submit an amended return using Form 1040X. Let me show you what happens when you stack these first two deductions together. Take a married couple. Both are 66 years old. They're both receiving Social Security and a pension. Their combined modified adjusted gross income is around $80,000. Their base standard deduction for 2026 is $32,200. Add the additional senior deduction for both spouses, $3,300. Add the new senior bonus deduction, $12,000. Their total deduction before a single dollar of income is taxed is $47,500. For a couple with modest retirement income, that alone could eliminate most, if not all, of their federal tax liability. And yet, tens of thousands of retirees are filing returns right now without it. Not because they don't qualify, because nobody told them. Tax break number 3, the qualified charitable distribution. This one isn't a deduction. It's something more powerful than a deduction, and almost no retiree who could use it knows it exists. Here's the setup. If you're 70 and a half years old or older and you have a traditional IRA, you can transfer money directly from your IRA to a qualifying charity. The transfer is called a qualified charitable distribution, or QCD. The money never touches your bank account. It goes straight from your IRA custodian to the charity. And here's what makes it so valuable. The amount you transfer doesn't count as taxable income at all. It doesn't appear in your adjusted gross income. It doesn't push more of your Social Security into the taxable zone. It doesn't trigger Medicare surcharges. It just doesn't count. In 2026, you can transfer up to $111,000 per person this way. If your spouse also has an IRA, they can transfer another $111,000. Now, most retirees aren't giving away 6 figures to charity every year. But here's the part that matters for the majority of people. The QCD counts toward your required minimum distribution for the year. Let me show you why that's huge. Imagine someone named Carol. She's 74 years old. She lives alone. She has a traditional IRA, and this year she's required to take out roughly $14,000 as her minimum distribution. She also donates $2,000 a year to her church. If Carol takes her full $14,000 RMD into her bank account and then writes a check to the church, the entire $14,000 is taxable income on her return. Her Social Security taxation goes up. Her Medicare premiums could go up 2 years later. But if Carol does a QCD, sending $2,000 directly from her IRA to the church before December 31st, that $2,000 is excluded from her taxable income entirely. She still satisfies $2,000 of her required minimum distribution. The church gets exactly the same donation, but Carol's taxable income is $2,000 lower. At her tax rate, that saves her real money. And if she was near one of the Social Security taxation thresholds, it could save her significantly more by keeping more of her benefits untaxed. The only mistake retirees make with QCDs is waiting until after they've already withdrawn the money. Once you take the RMD into your bank account, it's too late. The distribution is already taxable. The QCD must be sent directly from the IRA custodian to the charity. Most major custodians, Fidelity, Vanguard, Schwab, now allow you to do this online or will mail a check directly to the charity on your behalf. You just have to ask for it. Call your broker. Ask them specifically for a QCD distribution form and do it before December 31st. Not April 15th, December 31st. That's the deadline that matters. Tax break number 4, the medical expense deduction. Retirees are the single group in America most likely to benefit from this deduction, and most of them never claim it. Why? Because they assume they don't itemize. Here's how the medical expense deduction works. If your total unreimbursed medical expenses in a year exceed 7.5% of your adjusted gross income, you can deduct the portion above that threshold when you itemize on Schedule A. The threshold is permanent law as of 2021. It's not going back to 10%. Now, what counts as a medical expense surprises most retirees. Medicare Part B premiums count, Medicare Part D premiums count, Medicare supplemental insurance, Medigap policies count. Long-term care insurance premiums count, up to certain age-based limits. For someone age 71 or older in 2026, the deductible limit on long-term care premiums is approximately $5,000 to $60 per person. Dental work counts, hearing aids count, vision exams and prescription eyewear count. Modifications to your home made for medical reasons. Grab bars, wheelchair ramps, stair lifts count. Even mileage driven to and from medical appointments counts, at 21 cents per mile for 2025. Here's why this matters specifically for retirees. If you have a pension of $45,000 and Social Security of $20,000, your AGI might be around $50,000. 7.5% of $50,000 is $3,750. Now think about what a retiree on Medicare actually spends in a year. Medicare Part B premiums in 2026 are about $2,034 per person for the full year. Add a Medicare Part D plan. Add a Medigap supplemental policy. That alone for many retirees is $5,000 to $6,000 before a single doctor visit or prescription. Add one dental procedure. Add new hearing aids, which Medicare doesn't cover, and which cost thousands out of pocket. Add prescription copays. By the time you add it all up, a retiree with modest income on Medicare is often much closer to that 7.5% threshold than they realize. And every dollar above it becomes a deduction that the standard deduction never gave them. The mistake is assuming you can't itemize because the standard deduction is so high. With the new senior bonus deduction adding up to $12,000 for a qualifying couple, it's true that the bar for itemizing is higher. But if you have significant medical costs, you should run the numbers every single year. Don't file on autopilot. Tax break number 5, the credit for the elderly or disabled. This is the most overlooked tax break on this entire list. It's been in the tax code for decades. It applies to millions of retirees right now. And the vast majority of people who qualify for it have never seen it on their return. Here's how it works. If you're 65 or older, or if you're under 65 and retired on permanent and total disability with taxable disability income, you may qualify for a non-refundable tax credit worth between $3,750 and $7,500. Not a deduction, a credit. a dollar-for-dollar reduction in what you owe. The catch is the income limits. For single filers in 2026, your adjusted gross income must be below $7,500. For married couples filing jointly where both spouses qualify, the limit is $25,000. Those are low thresholds. This break is designed for retirees with very modest incomes who are still paying some federal tax. But here's the thing. A retired school teacher living on a modest pension and Social Security, a widowed postal worker whose income dropped significantly when her spouse passed, a retiree living primarily on Social Security with a small IRA distribution. These are the exact people this credit was built for. And in most cases, their preparer either doesn't know the credit exists or assumes the income is too high without ever actually running the calculation. The credit is calculated on Schedule R and then transferred to Schedule 3 on your Form 1040. The IRS will actually calculate it for you if you fill in the right information and check the appropriate box in Part 1 of Schedule R. You don't have to do the math yourself. If you're in the income range where this credit applies, you can eliminate your entire federal tax liability for the year. Let me bring it all together. Barbara, the one I told you about at the beginning, 28 years at the post office, $900 owed last April that she shouldn't have owed. Here's what was missing from her return. The additional standard deduction for age 65, $2,050, not on the return. The new senior bonus deduction, $6,000, not on the return. Medicare Part B and D premiums she'd been paying all year, over $3,000, which, combined with her other medical costs, would have pushed her over the 7.5% threshold and made itemizing worth it. Never discussed. And the credit for the elderly or disabled, which at her income level would have applied. Never checked. None of these required her to do anything special. None of them required a complicated strategy or a financial advisor or lawyer. They required someone who knew to look for them. That's the only difference between a retiree who gets every dollar they're owed and one who sends extra money to the IRS every April without knowing it. This is what I mean when I say the gap isn't wealth. It's the checklist. Here's your action plan. 5 things to do before you file, or before you amend. Step 1. Pull out your 2025 tax return. Check line 12 on your Form 1040. Verify that the age 65 or older box is checked. If you or your spouse are legally blind, verify that box is also checked. These are the easiest few hundred to few $1,000s in the tax code. Step 2. Look for Schedule 1A attached to your return. If it's not there and you were 65 or older in 2025 with modified adjusted gross income under $75,000, single, or $150,000, joint, you may have missed the senior bonus deduction. Talk to a tax professional about filing an amended return using Form 1040X. Step 3. If you're 70 and a half or older and you have a traditional IRA and you give to charity, call your IRA custodian today and ask about setting up qualified charitable distributions before your next RMD deadline. Step 4. Add up everything you spent on Medicare premiums, supplemental insurance, dental, vision, hearing, prescriptions, and medically related mileage this year. Divide your expected AGI by 13.3. If your medical costs are anywhere near that number, run both scenarios, standard deduction and itemized, before you file. Step 5. If your adjusted gross income is under $70,500 as a single filer, or $25,000 as a married couple, ask your preparer specifically about Schedule R and the credit for the elderly or disabled. If they don't know what you're referring to, find someone who does. Barbara filed an amended return. She got back $840. It took one conversation, one form, one person who knew to look. That's all it took. And that's the point of all of this. The tax code isn't designed to be simple, but it's also not designed to punish people who don't have accountants on retainer. These breaks exist. They're legal. They're accessible. The only thing standing between you and the money you're owed is awareness. So now you're aware. The question is, what are you going to do about it? Are you going to check your return? Are you going to ask the questions your preparer isn't asking? Are you going to make sure that the next time you file, every box that should be checked is checked? Or are you going to do what most people do, assume someone else is handling it, sign the return, and move on? Because that assumption is expensive, and it's costing retirees real money every single year. You don't have to be one of them.